Welcome to the Deep Dive, where we get you smart, fast. Forget the noise, we're digging into the core of things, connecting the dots so you can truly understand what matters.
And today, yeah, we're tackling a real head scratcher in the world of finance. The accrual anomaly. It's a puzzle that's kept researchers pretty busy for decades.
Okay, let's unpack this. So, the basic idea was companies report high accruals, these non-cash accounting items.
Right. Think changes in inventory, receivables, that sort of thing.
And, well, you'd think that signals good future earnings, right?
Mm.
But strangely, it actually pointed to lower future stock returns.
Exactly. And the initial thought, going way back to Sloan in 96, was basically investors are getting fooled.
Fooled how? Like,
Ah.
they just didn't understand the accounting.
Sort of. They'd see the high earnings number boosted by accruals, overestimate how long that boost would last, and then, well, get disappointed when the cash didn't quite follow. That was the prevailing interpretation.
So, investor irrationality. That was the main story.
For years, yeah. Almost all the explanations really leaned on some form of investor mistake, some misjudgment.
But hold on. We're here today because there might be another angle,
Right.
right? What if we flip that?
Yeah.
What if investors aren't necessarily making a mistake?
That's the mission for this deep dive. We want to explore a different way to understand this accrual anomaly, maybe a more rational approach.
Okay, so what's the alternative?
It brings us to something called the optimal investment hypothesis.
Hmm.
This idea has roots in what economists call Q theory.
Pew theory. Okay, briefly, what's that about?
At its heart, it's about the relationship between how the market values a company and what it would cost to replace its assets. It helps explain investment decisions.
Gotcha. And our sources for this are mainly academic research.
Yep, we're drawing on a lot of studies looking at the accrual anomaly itself, but also this growing field of investment-based asset pricing.
So, the potential aha moment here is seeing if this seemingly backward market behavior, high accruals, lower returns, actually makes sense when you look at it through the lens of company investment, not just investor mistakes.
Precisely. Let's maybe quickly revisit that irrationality idea first, just to be clear.
Right. Investors see high accruals, think, great, earnings up.
And they overestimate the persistence. They think those accrual-driven earnings are as durable as cash-driven earnings. But accruals, by definition, tend to reverse.
So when that reversal happens, or the expected cash doesn't show up, the stock price tanks, leading to that underperformance.
That's the traditional story. But okay, if investors aren't necessarily irrational, what's driving it?
This is where the investment link comes in strong.
Yes. The key argument here is that there's often a negative relationship between how much a company invests and the return investors expect from it, the discount rate.
Hang on, negative. More investment, lower expected return. That feels backwards too.
It does at first glance. But think about it. A company might only justify pouring tons of money into new projects if its cost of capital, its discount rate, is actually quite low. High required returns make fewer projects look attractive.
Okay, I can see that. Low hurdle rate makes more investments look good. So how do accruals fit into this investment picture?
Well, this is where it gets really interesting. Accruals, particularly things like changes in working capital inventory, receivables, again, they can be seen as a direct form of investment. They're part of funding the company's operations and growth.
Ah, so not just some accounting artifact, but a reflection of real investment activity.
Exactly. Researchers like Stickney, Brown, and Wallen, Bushman, Smith, and Zhang himself have really highlighted this connection. Accruals are tied to the tangible things a company is doing to grow.
Right, like building up inventory before a product launch.
Yeah.
That increases accruals, but it is an investment.
Precisely. Now, connect that back to Q theory. The theory suggests that firms adjust their investment based on the discount rate. If the discount rate goes up,
Meaning investors demand higher returns.
then because of things like diminishing returns, it gets harder to find equally good projects, or just the costs of scaling up big investments. Companies will tend to invest less, and that means accruals will likely be lower.
So high discount rate, less investment, lower accruals. And conversely,
Low discount rate, more investment is viable, potentially higher accruals. This link between discount rates, investment, and accruals is actually a key insight from this investment-based asset pricing literature.
okay, that's the theory. It connects the dots.
Hmm.
But does the real world data actually support this? How do we test it?
One major way is through factor regressions, trying to see what factors explain differences in stock returns.
Like the Fama French factors,
Hmm.
size, value.
Exactly. Researchers added an investment factor to models like that, basically a portfolio that's long stocks of companies investing less and short stocks of companies investing a lot.
What happened when they did that? Did it explain the accrual anomaly?
Significantly, yes. Adding this investment factor reduced the measured accrual anomaly by, well, by more than half for total accruals and discretionary accruals.
Wow, more than 50%,
Yeah.
just by accounting for investment levels.
Yeah. And for another related measure, the net operating assets anomaly, it explained over 60%. It really suggests a huge chunk of what we call the accrual anomaly is actually related to investment patterns.
That's compelling. Did they also look at, the characteristics of these high and low accrual firms?
They did. And interestingly, when you compare the firms with the highest accruals to those with the lowest, the spread in how much they invest is actually wider, more pronounced than the spread in their current profitability, like return on assets.
So the defining difference isn't just current profits, it's really how much they're putting into the business.
That's what the data suggests. Investment seems to be the more dominant characteristic separating these groups.
Okay, so high accrual firms invest more. But if investment is tied to lower expected returns, the discount rate, then maybe the lower future returns aren't a surprise after all.
Exactly. That's the next piece of evidence. Researchers tried to estimate the market's expected return, the discount rate for these different accrual portfolios.
How do you even estimate an expected return?
One common way is by looking at dividend growth models, methods used by people like Blanchard and Fama and French. You basically infer the discount rate needed to justify the current stock price given expected future dividends.
And what did those estimates show for high versus low accrual firms?
Really clear results. The high accrual firms consistently showed lower estimated ex-ante discount rates than the low accrual firms.
So the market was already pricing them as if they should deliver lower returns going forward.
That's the interpretation, yes. For example, one study found the lowest accrual group had an implied expected return around, say, 8.1% per year, while the highest accrual group was noticeably lower.
Which means the subsequent lower returns aren't necessarily a negative surprise, but maybe just the market getting what it expected.
It could well be. The lower realized returns might just be the rational outcome given the lower expected returns embedded in the price.
Now, there was also work on the reliability of accruals, wasn't there? Richardson and colleagues.
Yes, that's a key study. They broke down accruals into categories based on how reliable they are, how much they depend on management estimates versus more concrete transactions.
And they found the anomaly was stronger for the less reliable accruals.
Correct. Which, on the surface, might seem to support the investors get fooled by fuzzy numbers idea.
Right. But how does the investment hypothesis explain that?
Well, think about what those less reliable accruals often represent. Changes in inventory, changes in net non-current operating assets. These are very closely tied to direct investment decisions.
Ah, I see. So investing in building inventory or buying long-term assets directly impacts those less reliable accrual components.
Precisely. They might be less reliable from a pure accounting measurement standpoint, but they could be very direct signals of investment activity.
So the hypothesis would be that these less reliable accruals are more correlated with investment.
And that's what the evidence shows. Less reliable accruals are more correlated with investment levels.
Okay.
And importantly, when you control for investment in those factor models we discussed.
The ones that already reduce the overall anomaly.
Right. When you control for investment, the predictive power of these less reliable accruals for future returns diminishes significantly, much more so than for the more reliable accruals.
Wow. So investment seems to explain away more of the anomaly specifically where it was strongest in those less reliable numbers.
Exactly. And furthermore, these less reliable accruals also show a stronger co-movement with those estimated discount rates we talked about earlier. It all fits the investment story.
This really does flip the script. It suggests the market isn't necessarily ignoring fuzzy numbers, but perhaps rationally interpreting them as signals about investment and the associated expected returns.
That's the argument. It also ties into broader observations. High accrual firms often tend to look like growth firms, lower cash flow relative to price.
While low accrual firms look more like value firms,
Yeah.
high cash flow to price.
Correct. Researchers like Beaver and Desai, Rajagopal, and Venkatachalam noted these connections. And it makes sense, right? Growth often requires higher investment, which can lead to higher accruals.
So the accrual anomaly might be intertwined with the whole value versus growth dynamic viewed through an investment lens.
It seems likely. Now, another interesting twist is that the strength of this accrual anomaly hasn't been constant over time.
Right, you hear that about anomalies, they sometimes seem to fade away.
Yes, research by Green, Hand, and Solomon, for instance, suggests the returns from trading on accruals have decayed somewhat in more recent years.
And the typical explanations for that are.
Either investors have learned they're not making the same mistake, or arbitrageurs have become more efficient at trading the anomaly away, closing the mispricing.
Makes sense. But does the investment view offer a different take?
It does. Instead of assuming the anomaly is gone for good because of learning or arbitrage, the investment perspective suggests the expected returns from these accrual strategies might actually be time varying and predictable.
Meaning the potential payoff just naturally goes up and down with the economy.
Sort of, yeah. It suggests the weakening might be temporary, maybe cyclical, much like how the value premium seems to ebb and flow with economic conditions. Zhang wrote about this cyclicality in relation to the value premium.
So it's not that the relationship is broken, just that the expected reward for bearing whatever risk is associated with it changes.
Exactly, and there's evidence supporting this. Researchers have found they can predict returns on accrual-based strategies using variables linked to aggregate economic conditions or risk aversion.
Like what kind of variables?
Things like the variance risk premium, basically a measure of market uncertainty, or more traditional macroeconomic indicators like
Yeah.
treasury bill rates, the term spread, the default spread.
And these predict the accrual strategy returns.
The evidence suggests they do, yeah. It points towards time-varying, counter-cyclical expected returns. The payoff might be higher when the economy is weaker, for example.
Okay, so even the fading of the anomaly might have a rational, time-varying risk explanation. What about other bits of evidence originally used to support the irrationality view? Like the timing around earnings announcements.
Right. Sloan's original work highlighted that a lot of the return difference happens right around earnings announcements. That seemed like evidence of investors being surprised.
How does investment theory explain that concentration?
Well, think back to Cochrane's work connecting stock returns and investment returns. In an investment-based framework, a stock return should equal the return on the firm's underlying investments.
Okay.
And when do we get the most concentrated information about the success or failure of those investments and future prospects?
Around earnings announcements.
Exactly. So the market reacting strongly then isn't necessarily about correcting a past behavioral mistake, but about efficiently processing new crucial information about the firm's investment outcomes. It fits naturally.
That's a neat reinterpretation. What about things like analyst forecasts being overly optimistic for high accrual firms, or findings related to auditors, or even bond markets?
The investment framework offers potential rational interpretations there too, without automatically jumping to irrationality or inefficiency. For example, maybe analysts are optimistic because high investment is aimed at growth, even if the risk-adjusted expected return is lower. Or perhaps high accrual firms, with their lower expected returns, implying lower risk from the market's perspective, are genuinely less likely to face negative auditor opinions or have higher perceived credit risk in the bond market.
So you can build alternative stories based on rational risk assessment tied to investment.
That's the idea. It provides a consistent framework that doesn't rely solely on investors making systematic errors.
This has been really eye-opening. So wrapping this up, the big takeaway seems to be that this long-standing puzzle, the accrual anomaly, well, it might not be about dumb investors after all.
Yeah, I mean, the traditional view was strong for a long time, but this alternative perspective, rooted in rational investment decisions and their link to discount rates, offers a compelling explanation.
It suggests the market might be rationally pricing stocks based on their investment profiles, and the lower subsequent returns for high accrual firms are just the expected outcome given those profiles.
Exactly. And this view isn't just isolated, it aligns with a much broader shift in finance towards investment-based asset pricing models.
So here's a thought to leave you with.
Yeah.
Could it be that many of these market patterns we call anomalies and often attribute to behavioral biases? Could they actually have deeper economic roots? Maybe they're tied fundamentally to how companies choose to invest and how the market values the risks and rewards of those investments.
It really makes you reconsider the interplay between the accounting numbers we see, the real investment decisions companies make, and the expected returns that drive market prices. It's a complex stance.
It's definitely food for thought. If you want to explore this more, digging into Q theory, investment-based asset pricing research, and that whole ongoing debate between market efficiency and behavioral finance is the way to go.
For sure. It's a dynamic area, and our understanding is always evolving.
Absolutely. Financial markets never stand still. Thanks for taking this deep dive with us today.